School is the place that we are taught the lessons we will need to function as citizens in our adult life, right? If this is the case, why do studies from the University of Western Australia show that 40% of Australians have low levels of financial literacy? Welcome to Forever Finance, where we want to live our lives our own way. Whether you're just starting out on your financial journey or looking to sharpen your money management skills, these lessons will provide valuable insights to help you navigate the complex world of personal finance. Let's start with the first lesson: the power of compound interest. Compound interest is often called the eighth wonder of the world, yet it's a concept that many people don't fully grasp until later in life, if at all. In school, the basics of savings and interest might be touched upon, but the true power of compounding isn't emphasized enough. So what is compound interest? Simply put, it's the interest on a loan or deposit calculated based on both the initial principal and the accumulated interest from previous periods. This means your money grows exponentially over time rather than just linearly. Let's break this down with an example. Imagine you start saving $1,000 at age 18 with an annual interest rate of 5%, compounded annually. If you continue adding $1,000 every year, by the time you're 65, you'll have invested a total of $47,000. However, thanks to compound interest, your savings will have grown to over $215,000. Now compare that to someone who starts saving the same amount at age 30. They would have invested $35,000 by the time they're 65, but their savings would only grow to around $89,000. That's less than half of what the 18-year-old would have, even though they only invested $12,000 more. The lesson here is clear: start saving and investing as early as possible. The earlier you start, the more time your money has to grow, thanks to the magic of compounding. Unfortunately, this crucial lesson is not emphasized enough in schools, leaving many young people unaware of the importance of starting early. The second lesson is about the importance of financial literacy. In Australia, like in many other countries, the school curriculum doesn't prioritize financial literacy. Subjects like mathematics, science, and history are given much more attention, while understanding how to manage money effectively is often left out. However, financial literacy is one of the most important skills you can develop. Financial literacy encompasses a wide range of topics, including budgeting, saving, investing, credit management, and understanding taxes. Without a solid understanding of these concepts, it's easy to fall into financial traps like debt, poor spending habits, and even bankruptcy. For instance, credit cards are widely used in Australia, but not everyone understands how they work. Many young Australians are lured by the convenience of credit cards without fully understanding the interest rates, fees, and potential consequences of not paying off the balance each month. This lack of knowledge can lead to spiraling debt, which can take years to pay off. Another area where financial literacy is crucial is in understanding investments. Many Australians are not taught how to invest wisely, whether it's in the stock market, real estate, or other assets. As a result, they miss out on opportunities to grow their wealth over time. The takeaway here is that financial literacy should be a priority in everyone's education. If it's not taught in schools, it's up to individuals to seek out this knowledge themselves. There are plenty of resources available, from books and online courses to financial advisors and community workshops. The more you know about managing your money, the better equipped you'll be to make smart financial decisions for your financial journey. Our third lesson is understanding the difference between good debt and bad debt. Debt is often painted in a negative light, and for good reason. Too much debt can lead to financial stress and even ruin. However, not all debt is bad. In fact, some debt can actually help you build wealth over time. Bad debt typically refers to debt incurred for things that don't appreciate in value or don't generate income. Credit card debt is a common example of bad debt. If you're using a credit card to buy clothes, electronics, or other consumer goods that depreciate in value and you don't pay off your balance in full, you'll end up paying high interest rates on those purchases. Over time, this can lead to a cycle of debt that's hard to break. And on the other hand, good debt is debt that's used to invest in something that will likely appreciate in value or generate income in the future. A classic example of good debt is a mortgage. When you take out a loan to buy a home, you're investing in a property that has the potential to increase in value over time. Additionally, owning a home can save you money on rent, provide tax benefits, and even generate rental income if you decide to lease out part of the property. HECS or HELP loans can also be considered good debt if they're used to finance education that will lead to a higher paying job in the future. The key is to borrow wisely and ensure that the debt you're taking on will provide a return on investment. Understanding the difference between good debt and bad debt can help you make smarter financial decisions. Instead of avoiding debt altogether, focus on using it as a tool to build wealth and achieve your financial goals. The final lesson is the importance of multiple income streams. In school, we're often taught to aim for a stable job that provides a steady paycheck. While there's nothing wrong with having a traditional job, relying on a single source of income can be risky. Economic downturns, job loss, or changes in the industry can leave you vulnerable if you don't have other sources of income to fall back on. One of the best ways to protect yourself financially is to diversify your income streams. This means generating income from multiple sources, such as a side business, investments, rental properties, or freelance work. By having multiple streams of income, you're less dependent on a single source, and you have more financial security in case something goes wrong. For example, let's say you have a full-time job, but you also run a small online business on the side. If you lose your job, your side business can help you stay afloat while you look for new employment. Additionally, if your side business grows, it could eventually become your main source of income, giving you even more financial freedom. Investments are another excellent way to create multiple income streams. By investing in the stock market, bonds, or real estate, you can generate passive income that grows over time. This income can supplement your paycheck and provide financial stability in the long run. The key to building multiple income streams is to start small and be consistent. You don't need to create $1 million business overnight. Start with something manageable, like freelancing on the weekends or investing a small amount of money each month. Over time, these income streams can grow and provide you with greater financial security. Remember, it's never too late to start learning about money. Whether you're a teenager just starting out or an adult looking to improve your financial situation, these lessons can make a significant difference in your life. So, take the time to educate yourself, seek out resources, and start making smart financial decisions today. Your financial literacy journey has only just begun. Day-to-day habits are often the difference between make or break in your financial journey. Check out this video to learn more about the daily habits you need to avoid to achieve your financial goals.